Last week, a crypto investor lost $2.1 million in under 60 seconds. Not from a market crash, not from a bad trade, from clicking one single malicious link that drained his entire wallet while he watched helplessly. This isn't a scare story. This is the reality of crypto in 2026. And if you think it won't happen to you, you're already making the first mistake. Right now, as I'm recording this, there are professional scam operations running 24/7 with marketing teams, fake audits, AI-generated founders, and websites that look more legitimate than real projects. They're targeting you. Welcome back to the channel, and if this is your first time here, hit that subscribe button immediately because we're on day 3 of our 7-day crypto series, and today I'm going to teach you something more valuable than any trading strategy: how to survive in crypto. By the end of this episode, you'll know the 5 biggest risks that wipe out portfolios, how professional scammers engineer their attacks, the exact red flags to watch for, and the safety blueprint that separates survivors from victims. This is not optional knowledge. This is survival. Let's get into it. Before we dive into the risks, you need to understand why this matters more in crypto than anywhere else. Crypto is incredible. People build generational wealth, achieve financial independence, invest early in revolutionary technology, and escape broken financial systems. But crypto has a dark side that traditional finance does not prepare you for. Here are the numbers. In 2023 alone, over $3.8 billion was lost to hacks and scams in crypto. By 2024, that number increased. Rug pulls increased by over 70% compared to previous years. Phishing became the #1 way investors lost their funds, accounting for more losses than exchange hacks or smart contract exploits combined. Cross-chain bridge hacks caused some of the largest single-day losses in crypto history, with hundreds of millions vanishing in minutes. And here's the terrifying part. Crypto is permissionless. There's no bank to call, no official customer support that can reverse transactions, no FDIC insurance, no refunds, no chargebacks. If you make one mistake, send funds to the wrong address, connect your wallet to a malicious website, approve the wrong transaction, or fall for a sophisticated scam, your money is gone forever. Permanently, irreversibly. This isn't meant to scare you away from crypto, it's meant to prepare you, because the smartest way to succeed in crypto is not just choosing good investments, it's avoiding catastrophic mistakes. Professional crypto investors spend more time on security than they do on research. That should tell you something. Your ability to protect your assets is more valuable than your ability to pick the next 10x coin. So let's build your shield of protection starting right now. Let's start with the most obvious, but still the most dangerous risk: scams and rug pulls. These are not amateur operations run by kids in their basements. Scammers in 2026 operate like professional businesses. They have marketing teams running paid advertising campaigns across Twitter, YouTube, and Google. They hire influencers to promote their projects. They create fake white papers that look more detailed than legitimate ones. They pay for fake audits from companies that don't actually exist. They use AI to generate realistic founder profiles with LinkedIn accounts, Twitter history, and even fake conference appearances. Some rug pulls look more professional than real projects. Here's how a modern rug pull actually works. Phase 1. The story. The project creates a compelling narrative designed to trigger emotional responses. Artificial intelligence-powered trading bot that guarantees returns. Revolutionary blockchain for real estate tokenization, backed by a mysterious billionaire investor. Passive income through staking with guaranteed monthly rewards, the next Solana or Ethereum killer. These narratives are carefully crafted to target specific audiences: beginners looking for easy money, meme coin traders chasing quick gains, or FOMO-driven investors who don't want to miss out. Phase 2. The liquidity trap. They drive thousands of investors to buy the token or provide liquidity to decentralized exchanges. They create artificial hype through coordinated social media campaigns, fake trading volume, and manipulated price charts that look like explosive growth. Phase 3. The extraction. Once enough liquidity is in the pool, the scammers execute. They withdraw all the liquidity from the pool, which is called a rug pull. They dump their massive token holdings, crashing the price to zero. They disable trading or change contract permissions so victims can't sell. They delete all social media accounts, websites, and communication channels. And they vanish completely, often moving funds through mixers to hide the trail. Investors are left holding tokens worth exactly zero with no recourse. Now, here are the red flags you need to memorize. Anonymous founders with no verifiable history or previous projects. No real utility explained, just vague promises about disrupting industries. Roadmap looks generic, AI generated, or stolen from other projects. No actual development activity on GitHub or other code repositories. Tokenomics show unfair allocation, like the team owning 60% to 80% of supply. Aggressive marketing everywhere but weak or non-existent technology. Unrealistic promises like 100 times guaranteed, risk-free investment, or everyone will be rich. Low liquidity paired with a high market cap, which means it's easy to manipulate. No actual working product, just hype and promises. If you see 3 or more of these red flags, walk away immediately. No exceptions. The potential upside is never worth the guaranteed downside. Now let's talk about the number one way crypto investors actually lose their funds: phishing and social engineering. This is more dangerous than hacks or exploits because scammers don't try to break your wallet anymore, they try to break you. Modern phishing uses advanced psychological manipulation. Fake airdrops claiming you won tokens from a project you've interacted with. Fake customer support accounts on Twitter, Telegram, or Discord pretending to help you with an issue. Fake MetaMask security warnings telling you to verify your wallet immediately. Fake wallet connection screens that look identical to real ones. Fake NFT mints for hyped collections. Fake influencer accounts with verified-looking checkmarks promoting malicious links. Fake Telegram admins offering help in group chats. Fake email alerts claiming suspicious activity on your account. Fake Google ads that appear above real websites when you search for MetaMask, Uniswap, or other platforms. Here's the scariest part. They don't even need your seed phrase anymore. All they need is one malicious signature approval. You click approve on a malicious smart contract thinking you're claiming an airdrop or minting an NFT, and within seconds, your entire wallet is drained. Let me explain how permit and spend limit attacks work. A user receives a convincing link through Twitter DMs, Discord, or email. Claim your free airdrop, check your wallet eligibility, verify your account to prevent suspension. They connect their wallet to what looks like a legitimate DApp. They're asked to sign a transaction that says approve spending or grant permission. This approval allows the scammer's contract to drain all tokens, all stablecoins, and everything in the wallet except NFTs in some cases. And it happens in seconds. The victim realizes too late that their wallet is empty. Here's how professionals protect themselves. Never click links sent in direct messages. Ever. Not on Twitter, Telegram, Discord, WhatsApp, email, anywhere. No exceptions. Always manually verify URLs by typing them yourself. Look for tiny misspellings like metamask.security.io instead of metamask.io or appuniswap.xyz instead of app.uniswap.org. Bookmark all official websites and only access them through bookmarks, never through Google search, because scammers buy ads to appear above real sites. Use a hardware wallet like Ledger or Trezor for anything significant. Phishing attacks are 90% harder with hardware wallets because every malicious transaction requires physical confirmation on the device. Never share your seed phrase with anyone. No legitimate support team will ever ask for it. Not MetaMask, not Coinbase, not Binance, not anyone ever. If someone asks for your seed phrase, it's a scam 100% of the time. Now let's talk about smart contract exploits. This is where crypto gets technical, but you need to understand it because millions are lost to these attacks every year. Smart contracts are code that's immutable, permanent, automated, and transparent, which means if the code has a vulnerability, hackers will find it and exploit it before anyone can stop them. Once they do, millions can disappear in minutes. Here are the common types of smart contract exploits. Re-entrancy attacks, where hackers repeatedly withdraw funds before the contract updates balances, essentially draining pools by calling the same function over and over. Flash loan attacks, where attackers take massive instant loans, manipulate prices across decentralized exchanges, profit from the arbitrage, and return the loan all in one transaction. Oracle manipulation, where hackers feed fake price data to protocols that rely on external data sources, causing catastrophic liquidations or minting. Logic bugs, which are simple coding mistakes that allow unlimited token minting, incorrect withdrawal permissions, or broken access controls. And integer overflow or underflow bugs that break the math in contracts. Even audited contracts aren't 100% safe. Audits reduce risk, but they don't eliminate it. Complex protocols can still have hidden vulnerabilities that auditors miss. Here's how to protect yourself. Only interact with well-audited contracts from reputable firms like SureDK, Trail of Bits, or OpenZeppelin. Prefer established protocols with years of operation and billions in total value locked. The longer a protocol runs without incident, the safer it likely is. Avoid brand new yield farms or extremely high APR offers. If something offers 1000% APY, it's either unsustainable or a scam. Don't chase impossible returns. Use security tools before interacting with contracts, like Etherscan's contract verification, Go Plus Security Scanner, Wallet Guard browser extension, or DeFi Scanner. And never approve unlimited token spending. Always set custom limits when approving contracts to spend your tokens. Let's talk about centralized exchange risks. Even the biggest, most trusted exchanges are not completely safe. We've witnessed catastrophic failures. FTX collapsed in November 2022, losing $8 billion in customer funds. Celsius, BlockFi, and Voyager all collapsed during the 2022 bear market. Quadriga CX's founder allegedly died with the only keys to customer funds. Mt. Gox was hacked in 2014, losing 850,000 Bitcoin, and countless smaller exchanges have exit scammed or been hacked over the years. Billions of dollars have vanished because of one fundamental truth. When your crypto is on an exchange, you don't actually own it. The exchange does. You have an IOU, not actual possession. Here's the key rule every crypto investor must understand. Not your keys, not your coins. Centralized exchanges are vulnerable to insolvency when they mismanage funds or make bad bets. Internal fraud by employees or executives, hacks from external attackers, withdrawal freezes during liquidity crises, government seizures and regulatory actions, and collapse during market downturns when they can't meet obligations. Here's how to protect yourself. Use exchanges only to buy, sell, and trade quickly. Don't treat them like banks. Move long-term holdings to hardware wallets immediately. Ignore high-yield offers like earn 15% APY on your Bitcoin or stake your ETH with us for guaranteed returns. History shows these programs usually end badly when the exchange becomes insolvent. Stick to the most reputable exchanges with proper licenses, like Coinbase, Kraken, or Binance, but even then, don't keep significant funds there long-term. Enable two-factor authentication, but not via SMS because SIM swapping is common. Use Google Authenticator, Authy, or best of all, hardware security keys like YubiKey, and always verify withdrawal addresses by testing with small amounts first. Now we're entering the most important part of this entire episode. The biggest risk in crypto isn't scams. It's not hacks, it's not exchanges. The biggest risk is you, your emotions, your fear, your greed, your excitement, your impatience, your desire for quick, easy money. Crypto magnifies human psychology, and that's what causes most people to lose money, not external threats. Here are the main psychological traps. First, FOMO, fear of missing out. You see a coin pumping 50% in a day. Everyone on Twitter is talking about it. Influencers are posting screenshots of profits. You feel like you're being left behind. So you chase the pump, buy green candles, and enter at the top. Then it dumps and you're holding bags. Second, panic selling. The market drops 20%. Fear takes over. You sell at the bottom, locking in losses. Then the market recovers without you and you missed the rebound. Third, unrealistic profit expectations. You expect every coin to double tomorrow, 10 times next month, and 100 times by the next bull run. So you hold through corrections, refuse to take profits, and ride everything back down to zero. Fourth, overconfidence. After one winning trade, you think you've figured out the market, you increase position sizes, you take bigger risks. This is when catastrophic mistakes happen. Fifth, impulse trading. You buy something because 10 influencers mentioned it, or because it's trending on social media without doing any actual research. This is the fastest way to destroy a portfolio. Here's how to defeat psychological risks. Make a plan before investing. Write down your entry price, your target profit, and your stop loss. Set your entry and exit levels in advance and stick to them emotionally. Never invest more than you can afford to lose. This eliminates emotional panic. Never chase pumps. If you missed a move, there will always be another opportunity. Never hope your way out of a bad investment. Hope is not a strategy. Cut losses when your thesis is invalidated. Stick to long-term strategies instead of day trading or scalping unless you're experienced. Track your portfolio weekly, not hourly. Constant price checking increases emotional decisions. Surround yourself with facts and data, not hype and noise. Unfollow influencers who constantly shill, and accept that losses are part of the game. Even the best investors lose on individual trades. What matters is your overall win rate and risk management. Now, let's put everything together into your crypto safety blueprint. This is a step-by-step guide you can save and reference forever. Section A. Protecting your wallet. Use a hardware wallet like Ledger or Trezor for any significant holdings. Enable offline cold storage for everything long-term. Split your assets into two categories: hot wallet for daily trading and small amounts, cold wallet for long-term holdings and larger amounts. Use multi-signature wallets if you have large balances, requiring multiple approvals for transactions. Disable browser wallet extensions on browsers you don't actively use, and never store your seed phrase digitally. Write it on paper or metal and store it securely offline. Section B. Protecting your identity. Never post your wallet address publicly or link it to your real identity. Never engage in giveaway comments or reply to airdrop offers on social media. Never click links from strangers in DMs, emails, or comments. Never trust Telegram or Discord admins who DM you first. Real admins never DM first. Avoid using your main personal email for crypto accounts. Create a separate email just for crypto. Section C. Safe trading habits. Use stop losses to automatically exit losing positions. Use limit orders instead of market orders to control execution price. Leave profits on the side by withdrawing gains regularly. Withdraw gains to your cold wallet. Don't keep reinvesting everything. Take profits regularly and don't marry any coin. Diversify so one catastrophic loss doesn't wipe you out. And never go all in on a single trade, no matter how confident you feel. Section D. Project Due Diligence Checklist. Before you invest in any coin, ask these questions. Who are the founders and can you verify their identities? Is the technology real or just buzzwords? Is there actual demand for the product or service? Are the tokenomics sustainable or inflationary? Is the liquidity locked and for how long? Is the code audited by reputable firms? Does the community look real or filled with bots? Does the project solve a real problem? Is there meaningful development activity on GitHub? If you answer no to more than 2 or 3 questions, skip the project entirely. Section E. Emotional discipline. Have a clear plan written down before entering trades. Don't check prices every hour. Set alerts and walk away. Don't compare yourself to other traders on social media. Most are lying about profits anyway. Don't chase hype or FOMO into trades. Stick to your strategy even when it's boring. Understand that corrections and bear markets are normal and necessary. Accept losses as part of the game and move on without revenge trading. This emotional discipline is what separates long-term winners from those who blow up their accounts. Let me leave you with the most important rule of all. Your number one job in crypto is to survive. That's it. If you survive the scams, the hacks, the emotional traps, the bad projects, the exchange failures, and your own mistakes, you will naturally profit in the long run because crypto rewards patience, discipline, and self-protection more than anything else. The market goes through cycles. Bull runs come and go. Projects rise and fall. But if you're still here with capital intact, positioned properly and emotionally stable, opportunities will come to you. Big opportunities, life-changing opportunities, but only if you survive long enough to see them. Security isn't sexy. Risk management isn't exciting, but it's what keeps you in the game. And in crypto, staying in the game is everything. Thank you for watching. If you learned something valuable today, make sure you hit subscribe because we're building a community of informed, disciplined, smart investors who don't fall into traps and don't get shaken by fear. Tomorrow we continue with day 4 of our series, and we're diving into altcoins, how to identify real projects with utility versus pure speculation. Drop a comment below and tell me what's the biggest risk you think most people underestimate in crypto. I read every comment and I'll be using your answers in future episodes. Stay safe, stay smart, stay disciplined, and I'll see you in the next one.